Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back, everybody. See if I can get my volume set here. Sorry about that. It's kind of rough. I have to wait until the show actually starts so I can make my adjustments to the instruments. But hey, if you'd like to call in, the number today, if you have any questions, 216-901-0945, 216-901-0945. And if you're just now finding this channel, I'm Bill Bullington. I'm here every Saturday morning from 11 to noon. I own Bullington Capital. We are a registered investment advisory firm. And if you'd like to know more about us, you can go to bullingtoncapital.com. Just go Google it or Google Bill Bullington. It'll bring you there. And it's pretty interesting. Every week I'm perusing through different magazines. I spend my Saturday mornings before I come in to do the show at Borders Bookstore, going through the financial publications, and it's kind of fun. It's unbelievable how many different products have come and gone over the years. It's stuff that I thought would be there forever, and it looks like Wall Street Journal is one of the ones that has been there the entire time I've been in my career, which is, I'm almost embarrassed to say how long it is, actually. It's over 30 years. Let's put it that way. And but yeah, and I was looking at stuff, and almost, it's really tough when you go back and you look at the headlines today. If I were to keep these things and take them out 10 years from now, maybe, I don't know, it's probably 25%, 1 out of 4 predictions or stories actually comes to fruition the way that it was presented. And most of them come up in a different, if they come up at all, and occasionally something that you think this is just going to be a home run, it ends up not being one for some reason. And then things that you think have very little chance end up dominating. I've seen that happen a million times. Well, probably not a million times, but a lot of the time. And so it's very, very difficult to predict. The trends that you can predict is I make this prediction, and by the way, stock market forecasters, I think one of our jobs is to make fortune tellers look good. And it's across the board. I mean, I have a Bloomberg terminal. I can get access to anything that's out there, any type of news. And if you ever start writing that stuff down and then going back 6 months, I stopped doing it a long time ago, because this was actually an idea that was presented to me by other money management firms and other managers. Write down what you think is going to happen, and then 6 months from now, come back to see how many of those things actually happen, especially the way you thought they would. And you'll do that for probably a couple of years if you've got a lot of grit, like I did. And then you're never going to do that again. You'll see how poorly your ability to accurately forecast the future is. And one of the reasons that funds that you're using to invest in are not, the people are, the vast majority of them today are not quote unquote actively managed, where people are actually trying to do that. They're trying to forecast what they think might happen in the future. And the very best of those are typically getting beat by market cap weighted indexes. And what's a market cap weighted index? Well, the most popular one is the S&P 500. By far, that's the most popular one. And it's also very, very difficult to outperform in the long run. And you might beat it in the short run, but when you're looking out over a 20-year retirement, there are some other things I'd probably do. Now, there are other indexes, there are other funds that have done better than that, and I can tell you why. After all the years of working on this stuff, there are some factors that have a tendency to matter more. And size, or in other words, market capitalization, if you don't know what that is, don't worry about it. It's basically just how much is that company's stock worth. If you added up all the shares that they have issued and multiplied it by its current share price, what is that? Now, the bigger ones have a tendency to be more solid than the smaller companies, which is kind of common sense if you really step back and think about it. But the smaller companies that go on to become the bigger, if you can identify one or two of those in your lifetime, one or two of those companies that come up through the ranks and they just continue to grow, kind of like Google did, kind of like Amazon, and they end up acquiring a bunch of other businesses as soon as they get to the size that they can, or they copy other small businesses that are doing very well, and they put that in their own portfolio. But those are home built, actually. They're not actually acquired. Those are the companies that have a tendency to do the best over time. Those that can find ways to continue to increase their revenue. Revenue's important. It's the next thing that's most important is profitability. If you're just growing your sales but your profits aren't growing, that's a problem. And one day, if that continues that way, it's going to be a big problem. And so I guess the reason I'm talking about this is I still get calls. People want to know what I think about XYZ stock. And I don't mind looking at it. I do a lot of that. But realistically, there are so many programs now that, especially with AI, the AI is already being used by people like myself, who use. I get most of the stuff that I'm doing through the custodians that I'm using. I use Goldman Sachs and Fidelity. Those are my two primary. I have Axos as well. But they've got tools that make all this stuff much, much simpler. Just because it's simple doesn't mean it's easy. And I'm always using this a boxing analogy. Boxing's pretty simple. It ain't easy, especially if you're not really good at it. So it's one of the reasons I stay out of the ring. I've got eyes. My eye sockets the bones are so sharp. Every time I get hit on one of them, it splits open. I got to get stitches. Yeah, I haven't had to do that for a very long time, since I was a kid. But it was happening all the time. I mean, I would run into stuff. I got hit in the eye with a baseball one time, playing baseball in the backyard. I fell out of a tree I was trying to build a fort up in a tree, and I fell and it hit my face on the way down. Back, more stitches. Anyway, so we don't want to. I don't want to get too far into that. I'll change the subject here. Really, that's actually getting kind of gory. But anyway, so Newsweek is got some really interesting headlines this week, and the cover of Newsweek is pretty interesting. It's about the future of robots, and the main title on the magazine cover is "Killers by Design: How Humanoid Robots Could Transform Warfare." And there's a whole bunch of it about the robots going and fighting wars. It just seems like like a movie. Especially if you grew up in the era that I grew up in. The Star Wars was actually pretty popular, and we're not even remotely close to what the first Star Wars movie was at that point in time. And I'm embarrassed to tell you how many years ago that was. But Newsweek's still running on the cover. It's still there. And that's another thing that very, very difficult when you're trying to make investments. Okay? And you've got to, at some point in time, you're going to have to start taking money out. When you start taking money out, you don't have time to have investments in there that are not producing. That's a really not a good way to manage your money at that point in time. If you're below the age of 40, if you're 40, 45, you can still kind of do that sort of thing. But if you are, getting close to the age of 50, now's like the get serious time. And there are lots of portfolios out there. We've got a few hundred that we like, that we've narrowed it down to. That's a lot. But to basically match what I feel like are all the various personalities when it comes to investing, because investing is very, very personal. There's no real right way or wrong way of doing it, but there is a right way to do it for you. I've been very adamant about that my whole career. No one will ever match the performance of the best performing indexes, because the best performing indexes typically have a lot of fluctuation. The higher the returns, more often, the higher the fluctuation is going to be. And so you've got to be willing to sit through all that to be able to access those types of returns. And one of the biggest misconceptions, it's always been that way. And I thought, if you'd have told me when I first started doing this program 30 years ago that I would still be having this same conversation, I would have said, no way. People they've got to find this out by them. But no, and I get it. It takes a lot. It takes a lot of time. If you're young, it doesn't seem like it's as hard. And you guys, young people out there, have much better tools, but it is still rough. Like, I've got a portfolio that I run. I take the top Russell 1000 Growth Index. Okay, it's a little over 100 stocks, and I'll take the top 40 out of that group. So I'm cutting 100 down to 40, and then I'll go in every quarter and rebalance that thing. What does rebalance mean? Some of them we are actually doing on a monthly basis. Depends on the client. But you go in and rebalance. If they've dropped out of the top 40, then you're going to replace the stocks that are no longer in that top 40 with the stocks that are. And then you're going to redistribute any profits on the companies that are still going up faster than the market in general. And that's basically it. It's a little expensive to get the data, especially data that's of high quality. And I don't want to say it's a little expensive. It's a lot expensive. It's about $30,000 a year. But if you're doing it for a bunch of people, and you can probably afford it, as an individual, not so much. And anyway, and I've had some people talking about it. One of these days, I think, probably coming up here, maybe in the first quarter. Yeah, first quarter, we will do another seminar. I haven't done a seminar since COVID. Man, it's a long time ago, and I've been doing the radio program pretty much. So I guess we're due, and you'll be able to see a lot of the things that I'm talking about here, how we're implementing that. We got to a certain size, and I know I've been kidding around about this, but from one of the custodians I have, they had this group of people, and kind of reminded me of the movie Men in Black. And I've only got about 50 seconds before I have to take a real quick commercial break. So I want to leave you hanging there. Just remember the Men in Black, and when we come back, I'll explain what I mean by that. This is Bill Bullington. I'm right here. If you would like to call in today, 216-901-0945. And we'll be back in a few minutes. Well, welcome back. Men in Black. I remember when that movie was brand new. That's how old I am. That was pretty good, too. So I'm sure most people probably watched it on cable somewhere. But, yeah, I was looking at, this is interesting. It was Newsweek of this week. And a big portion of the magazine is basically on autonomous, humanoid, basically robots. And people are going to start to use them, I guess. And you know how long I've been hearing this? I mean, it's unreal when you read as much as I do, how many things come out. Now, they weren't very popular at first, weren't making headlines like they are now. But you're looking at this stuff, and it's like 15, 20 years before you actually see it. And I can remember back in 1996 talking about the internet. Nobody knew what I was talking about. They had no idea what I was talking about. And I started thinking, yeah, you'll have these, your computers, you'll be able to get online, you'll be able to see pictures, you'll be able to talk to each other, kind of like the Jetsons. And that was a cartoon that was around, and boy, was that ahead of its time. And we still don't have the cars that you can fly. They have cars like the cars they had in there, but they're extremely expensive, and I'm pretty sure they can't figure out how to put a highway of cars in the air. So that's probably not happening anytime real soon. But I just thought it was interesting that Newsweek decides to put a robot on the cover of the page, and they did a big story in it. And that's one of my points behind this whole thing is oftentimes I used to get questions, not so much anymore, but I used to get questions about what would be, what's going to happen down the road? What's going to happen with this? What do you think will happen with that? Well, the thing is, if your parameters are set up and your management accounts to be able to track and make adjustments to the companies as they're changing, okay, then you don't need to know. That's, and I know that upsets some people, especially the younger they are, the more upset they have a tendency to get because they want to try to predict something and hit it right on the head. Yeah, you'll grow out of that one day. And if you keep with it long enough, you'll give that up. And the better thing to do is to say, okay, I'm willing to take X amount of risk. And let's say I'm willing to see my portfolio drop by 40 or 50%. Now, this is where an advisor comes in. Because if you're barely getting by on Social Security and you've got $100,000 in total savings, which is, by the way, you'd be shocked at how many people actually get to age 65, and that's where they're at. Okay, and I go, and you think that, well, the stock market's average 10% a year. It depends on which decade you're looking at, by the way. But the stock market's average 10% a year, so I'll just take 10% of 100,000. That's 10,000. Yeah, and I add that to my Social Security, my pension, if I have one. I think that's pretty good. Well, if you're taking out 10% a year, and your life expectancy is more than 20 years, there's a pretty good chance you're going to run out of money. And that's like the opposite of the goals that we're looking for. So you just don't want to do that. And that's why, people are, we get a lot of flack about robots coming in and taking over our business. It's going to be a while. And incidentally, when you invest in index funds, which is essentially what I do, because there are 3,000 indexes out there, and if you can memorize each and every one of those and how the stocks are selected, well, you should be doing what I'm doing, no sweat. But reality is there are several thousand options to be able to use, and sometimes it's just nice to have somebody to reassure you. And I work with a department at one of the biggest, if not the biggest, asset managers on the planet, and that's Fidelity. And we work together with a department there. We'll kind of take a look at what your risk tolerance is. I was so proud that they adopted my risk tolerance questionnaire after 15 years of doing. Actually, it was actually after 50 or 60 years when investment questionnaires came out. And I just looked at them and I was going, man, nobody understands those. It's one of the reasons I left to start my own practice. I was so upset that they've got these questionnaires. They're 4 pages. You've got 60-something questions. Most of them, nobody has any idea what the correct answer should be. That includes the people that are asking the questions. And so that's what it was like. And then we were being threatened constantly by the regulators. You better stick to those prudent man rules. Well, they would never define the rules that we were supposed to be sticking to. So you realized, like, if they just got a bad feeling, and I have a pretty good feeling myself that that's what they were looking for. If they would come in and do an audit, we get audited all the time, and they find something, or if something just doesn't seem right, it gives the auditor the ability to write you up for something, and could literally shut your practice down. So, and it's not too far off from that right now. You really have to know a lot of stuff, and you got to stay within their various guidelines. And it has improved, by the way. It's improved, and they've come to see the light in a certain amount of things. So you don't have to worry about that as much as you would have in the past. And most of my asset management business, the asset management business is completely fee-based. There's no commission. So I don't get paid anymore to sell one product over another one. Some of the portfolios I actually run myself. One of the ones I like the best is one that I run myself. And I got the idea from a couple of companies that were around back when I was new in the industry, and they grew to become behemoths, and they couldn't do what they were doing when they were smaller because they were too big. They were actually moving the markets themselves. And there were a bunch of funds from Fidelity that were like that too. They had extremely high returns, extremely high turnover. So you were going to, if it wasn't in an IRA, you would have to pay taxes on everything that you made practically. And there were some years where if the market had a bad fourth quarter and you got in the first quarter, or let's say you got in the third quarter, and all you see is a big decline, and they paid a capital gain and distribute it. You ended up, not only did you end up having less money, but you got to pay taxes on someone else's gains. Yeah, that makes sense, right? So there are lots of pitfalls you got to be aware of, hopefully aware of. And man, I remember that. That was like it was yesterday. I was just thinking, oh man. I had clients asking me, hey, do you think I should do this? Maybe I would probably wait, let's wait until after the beginning of the year, or at least until after their fiscal year is over. Because back in those days, companies had fiscal years, they would end all over the place, and that would have some impact on whether or not you'd include the gains for that year or not. So, but anyway, looking at things that are going on today, it's pretty interesting. Again, the options are not nearly as many as there used to be. There's still several thousand, though. That's a lot. And there are more funds than there are stocks anymore, and which I always thought was kind of funny. I mean, it's been that way for several years now, probably more than a decade. But I always thought it was funny that you actually have more stock funds out there, and I'm including funds that would be in a variable annuity. That a variable annuity is an annuity that has mutual funds in it. Technically, they don't call them mutual funds, but it's basically the same structure. And a lot of the funds that are managed by the same companies and are holding the same stocks as the ones that are not in the annuities. So bottom line is there's a lot of choice there. The annuity can provide tax deferral. That was one of the big benefits to having those funds inside of an annuity, is that whenever they pay the capital gains and dividends, so what? It's protected by the annuity. It's being tax deferred. And a lot of people like that a lot. And I like the annuities for a big portion of the fixed income. Fixed income is anything that's got a guarantee to the principal, and or sometimes they guarantee the interest rates. So you got to look into that, and I don't really have enough time to go into all the details about that. So if you have questions about that, please feel free to give me a call. I've done a lot of work over the years with annuities. I'm glad they're there. I have several of them myself, and I like the idea that I'm going to be able to get a return it's a really good return, and a really good. That depends on the person that's describing it. I'm looking at the guaranteed income that I'm going to get when I hit Social Security's full Social Security age, which is only 5 more years. Can't believe that either. But I'm full Social Security age. That's when I'll be able to take money out without getting penalized. I'm still going to be working. In fact, I'll be going out with my boots on. Yeah, there's nothing. I think about that a lot now. Like, man, what would I do? Where I would be unbelievably bored. I don't. When you do this for a living, this is practically all that you do, and you don't really have time for a whole lot else. So my time's a lot more free now. When I say that, of course, I'll have 5 people calling that need something yesterday, and that happens a lot. By the way, if you haven't gotten your, I know we've been talking about this for a while, but if you haven't gotten your required minimum distribution in for this year, there's a really good chance you're not going to get it done. Yeah, and I know you get, well, it's 3 weeks away. Tough, because everybody in the country likes to try to wait until the last second, and you want to all crowd in at the last month. And I'm sorry, not my rules. It's the custodians themselves. They will not guarantee that you're going to get that out in time. And that's on you. And especially when you're one of our clients, because we start sending letters out in August. So you've gotten multiple warnings. And the reason I get my voice goes up when I'm talking about this is we have people calling in like they never got anything. Like, you don't read our communications. You don't read the ones that the brokerage firms we're using are sending out. So because between the two of us, that's a lot. There's a lot of communication there. And you would think that at some point in time in your life, you got to remember and get those distributions out there. And that's a big deal because the penalties are huge. You don't get what you need to get out. And by the way, if you miss for this year, to take the distribution for this year, you have until taxes are due in April to get that done for this year. Okay. But you can't do that again the next year. You can't put next year's distribution off until April of the year after it. You're going to have to take it before December 31st. Otherwise, you get a big penalty. So it's just stay on top of that. Do as much as you can. And I can't tell you, we start sending stuff out, and every year somebody waits. There was one year, and if they're listening, they're probably going to get mad at me. But they waited until 3:45 on the last business day of the year. So we got 15 minutes to get a distribution that you've had all year. and I couldn't believe that we got it done. I mean, it was mind-boggling. And but when we did get it done, even the custodian was like, "Hey, don't ever do that again." It wasn't us. We did not wait. It was the client. So, got to be a little bit responsible there. And everybody, by the way, the people that wait that long, and they always want to blame somebody else. Not my fault. Yes, it is. Sorry, it's your money. It's not my money. And we're just here helping you with it. So I will stop this rant and tirade. I feel bad for you. But we've always been trying to look at different things. This year we added back a portfolio that I took away, and then looking back, that's probably a mistake. I took it away from people because the portfolio has a lot of turnover in it. It's one that I copied from a couple of mutual funds that had been around and had done extremely well in the 70s and 80s. And actually, they've done extremely well since then. So I knew what they were doing. It's very expensive to pay for the data that you need to be able to duplicate those things, but I just sucked it up and paid for it again. I just restarted this just a few months ago, actually. I kind of missed it. I missed the action myself. So I've only got a few seconds here before I have to take a quick commercial break. This is Bill Bullington. I'm right here on 1420 every Saturday morning from 11 to noon. And when we come back, we're going to talk about what that strategy is, how you build that together, what you can expect from it. And I really like it. It's my favorite strategy. So, and I'll tell you about my second, third, and fourth favorites too. Favorites. Anyway, this is Bill Bullington. I'm going to take a real quick commercial break right here, 1420 every Saturday morning, 11 to noon. Hang on, because I'll be back right after these messages.
Teenage girl, much too young, unprepared for what's to come.
Well, glad to be back. If you have a question, you can call 216-901-0945. You can go to my website if you'd like more information on anything you hear me talking about on this show today. I can't believe how long I've been doing this thing. It's mind-boggling. And the technology is changed. The me when I started doing this platform would not recognize much of anything in the business today. And change is inevitable. Change is constant. And that's one of the things you really want to try to stay kind of away from. And for younger generations, they don't really care that much. At least I haven't ran into a lot of people that did. They'll look at the fund's performance, and that's it. Which is the same thing their parents did, by the way. They look at the fund performance and go, well, look at how good the performance is in that one. And then they see the stocks that are in there. And, if that was all it took, my field wouldn't exist at all. And all the information is out there if you look for it. But there's it's one thing to be able to find this stuff on paper. It's another thing when you see your portfolio going through those machinations and you see the ups and downs. So a lot of people can do it. There's no doubt about it. But some people, like, if I didn't do what I did for a living, I wouldn't want to do this. It's too volatile. And the things that you need to do, the things that are necessary if you're going to have above average returns, are incredibly difficult to do. So it's just like, you can watch a football game and say, oh, wow, he shouldn't have dropped that pass. I wouldn't have dropped that pass. Yeah, right. Yeah. Or I missed that shot, as time ran out on the clock. Or I would have hit a home run and won the game for you. It's easy to say. It's a lot harder to do. And no doubt, it's there's more information available today than ever. I'm not so sure that's a good thing. A lot of the material that you do need to know is harder to deal with emotionally than it is intellectually. So there's a combination there. And if you're looking, if that's the kind of thing you're looking for, the main item in your plan for your retirement, for building it up and then taking distributions, the main element is confidence. That's what you need is confidence. And how do you build the confidence? Well, if you don't have it yourself, if you don't think, if the market's down 50%, I am not pulling my money out of the market. I'm going to rebalance my portfolio. What does rebalance mean? We'll go into that in the last 10 minutes. But I'm going to rebalance my portfolio, and I'm going to take advantage of the fact that market prices are lower. At some point in time, you may end up, if you're doing that without knowing what valuations are, you're probably going to end up doing it multiple times during a big decline. You get the 2000 through 2003, and then November 2007 through the first quarter 2009. Those were big. Those are gigantic declines. They were over 50%, both of them. And so at one point in time, if you'd invested, let's say you just made your first investment because your luck was really bad in March of 2000. In March of 2003, there were an awful lot of people that just closed their accounts and never came back to stocks. That's pretty mind-boggling. And of course, they've missed everything since then. But that's one of the advantages that you have if you're younger and are investing in your 401ks through work. That is just a gift, because when the markets go down, you're buying more shares. The money that you're investing is buying more shares because of the way 401ks work. They take out a certain percentage of your income, and your income doesn't go down because the stock market went down, or at least hopefully it doesn't. Mine does. But if you're putting the same amount in each month, you're getting more shares when they're cheaper, and you're getting fewer shares when they're really high. So there's that's built in. And I don't know how many people actually even talk about that. In fact, I haven't heard anybody, but it's not like I'm actually trying to listen to that stuff anymore. And if you want to know which types of portfolios have the best long-term track records, okay, they're normally fixated on growth, sales growth, profit growth, and then you combine that. The timing aspect of it is called the market capitalization. That's basically just what is the whole company's stock market value, and what if you added their debt and their cash, and came up with a number. Okay, this is basically a value of this company if you were to pay the share price that it's selling at right now, and paid off all their debts, and that's basically kind of it. Although anytime I say that, I keep thinking in the back of my mind, there are a gazillion of what ifs. What if this happened? What if they have that? What if yeah, everything in the market's just an estimate. It's kind of like the weather. If you're really good, if you're really good at estimating weather, you're probably right about 30% of the time. And nobody likes to hear that, by the way. 70% of short-term forecasts turn out wrong. Now that's changed over the years because now we have satellites. And for a long time, we didn't have satellites, and that's been that way for quite a while now. So can't really use that analogy much like I used to. That's kind of funny, reminiscing about what's gone on. But a lot of the things that are staying the same is that it's hard to save money. It's always been hard to save, and that's a psychological issue. The practicality comes into play when you realize, when you haven't looked at this like right off the bat. If you're a young person and you're thinking about getting married, you need to have a talk about budgets. And yeah, it's not exciting, In fact, you know, finances cause more divorces than just about it. I think 50% the last time I looked, which was a long time ago, so don't quote me on this, but literally half of half of divorces were due to financial issues between the couple. Half. That's a lot. Okay. So I don't know. I really don't know if it's changed a lot, despite the fact that people have access to a lot more information out there. And one of the problems with having more information is there's a lot of really bad information, and it sounds like it makes sense, and that's an issue. And that's something you'll work through if you're taking this journey alone. You'll work through that eventually. You'll know when somebody's not really telling the truth, but that can take a long time. And again, that's why you want to have advisors. Just look over the portfolio. There's certain things that, somebody that's got that's been around for a long time. Okay, you can't stay around a long time in my business if you're not pretty good. I mean, there are a few out there that are still out there that just aren't that good, but if you're going to make it for more than 10 years, you're going to make a career out of it, you're going to get good. You're going to have to, because you'll be eliminated if you're not. You just won't be able to make any money. So you'll get pretty good at it. And by the good part, I don't mean that you're going to get better at predicting the future. That's what the novice investors think. Not all of them, but a lot of people think that, you're going to know what's going to happen in the future. Yes and no. I can tell you 10 years from now, there's a really high probability that stocks are going to be selling at higher prices than they are today. And most people give me, well, that's not saying too much. Well, see that? No, that's because you're not a professional. That's why you think that. And if you were professional, you would go, oh, yeah, well, it might not. And that's true too. What makes a good companies? This is what I liked about today. I'm working with mostly Fidelity, and they've got a bunch of different ideas that you can work with. Some of them more aggressive than others, but you've got to be able to recognize that. And the thing is, we can always pick up the phone and call. So if you're an advisor in your 30s, and I'd recommend these guys. If you're independent, I would add them. They're one of the largest asset managers in the world. They didn't get there by not doing a good job. And I've been very pleased with what I've seen through my own experience with them. And I've got money that I still run, because there's if you have a portfolio that's mostly, you want them tax deferred. Okay, so if you got some money in an IRA or rollover or whatever, and you just want to be a little bit more aggressive with it, here I'll describe exactly what I'm going to do. Now, when I describe this, I'm going to have callers that are going to call in, and they're going to want me to go into deep dive details. Well, I'm going to tell you right now, you're going to be gravely disappointed. I do not have time to hold your hand and go through all of this. If you're wondering where to get the data, I'm going to tell you Bloomberg, and you're probably going to call Bloomberg. You're going to find out how much it costs, and you're probably going to change your mind. There are some sources that are available that are less money online, but they are nowhere near as flexible as you're going to need to be. So, because I would love to be able to not have to pay a couple $1,000s a month just for that data. So I'm on it. If it ever does become available, I'll let you know. But anyway, so model I liked a lot that I changed a little bit from Janus and 20th Century from way, way back in the day. And there were a bunch of other funds that there were mutual funds that have come and gone. Because this strategy is literally as aggressive as you can get without being dumb about it. Okay, so basically you're going to be aggressive The goal is to make as much money as you can. You got to be willing to put up with a lot of volatility and a lot of movement. So if it's not a small portion of one of your IRAs, I'm not sure I would do it. There are some other funds that come very, very close to doing what I'm going to be doing in that particular strategy. That you're basically, the only reason you would do the stocks is because you like stocks. And that's like me. I like stocks. I get it. I came up in an era when I used to manage all the stock portfolios on my own. I was spending way more money than anybody I knew. It's probably one of the reasons I'm still working. But I just liked doing it. It was a lot of fun, and I still like running the screens. But it's all it's a process now. I go in, run the screens, export the securities out to the platform, and hit rebalance. And I only got about 15 seconds here before I got to sign off. This really flew by. If there's anything you want more information on, just go to my website, bullingtoncapital.com, or you can call us 330-664-0700, 330-664-0700. And I hope you guys have a really good holiday season. I will be back next Saturday morning at 11, and I will talk to you then.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.